Hello everyone, and welcome to Accounting Insights with Rula. In today's session, we'll dive into solving problems related to the accounting equation. Pause the video whenever a question appears, take a moment to solve it on your own, and then resume to review the solution. This method will help strengthen your understanding and build your confidence. Let's get started. Question 1. Fill in the blank with the correct answer. Take some time to work through the problem on your own. Once you are ready, you can resume the video to check your answers and see how you did. Let's go through the answers together. The four phases of accounting are recording, classifying, summarizing, and reporting. The accounting equation is assets equal liabilities plus equity. Number 3. Items owned by a business that have a monetary value are known as assets. Number 4. Owner's equity is the interest of the owners in a business. Number 5. Money owed to an outsider is a liability. Let's move on to the remaining question and complete the sentences together. The difference between assets and liabilities is owner's equity. An investment in the business increases assets and owner's equity. To purchase on account is to create a liability. When the words paid on account occur, it means a reduction of the assets cash and reduction of the liability accounts payable. Income increases net assets and also owner's equity. A withdrawal of cash reduces cash and capital. Before we continue with question 2, let me quickly remind you of two key points from Mr. Allens-Began example in our first lesson. Equity increases through investments and revenues as they add value to the business, while it decreases through expenses and withdrawals, which reduce the capital available to the owner. Let's continue with question 2. How do the transactions below affect the owner's equity or capital? I prefer to examine the effect on both sides of the accounting equation. Transaction A. Tamara invested $5,000 in the business. This investment increases both assets, cash, and equity by $5,000. Transaction B. She bought equipment on account of $2,400. Buying equipment increases assets by $2,400. Since it was bought on account, it also increases liabilities accounts payable by $2,400 and no effect on equity. C. She paid half of the bill owed to the creditor. When Tamara pays $1,200 to the creditor, both assets, cash, and liabilities accounts payable decrease by $1,200, no effect on equity. Transaction D. She received $2,000 in fees. Receiving fees increases both assets, cash, and equity by $2,000 because it's income earned by the business. Transaction E. She paid salaries for the week of $800. Paying salaries decreases assets, cash, and equity by $800 because it's an expense. F. She withdrew $400 from the business. A withdrawal decreases both assets, cash, and equity by $400. G. She paid rent for the month of $900. Paying rent decreases both assets, cash, and equity by $900 because rent is an expense. H. Inventory of supplies decreased by $350 during the month. The inventory decrease reduces assets, supplies, and equity by $350 as it's recorded as a supplies expense. Let's look at this scenario. Imagine Miss Nadia, who owns a commercial center, asking her accountant Laura to help her with the month's transactions. Laura's job is to go through each transaction, determine which accounts are affected, and then assess whether those transactions result in an increase, a decrease, or no change in the accounting equation. Let's look at the table that Laura prepared for Miss Nadia to summarize the effects of the transactions during the month. Transaction 1. Miss Nadia invested $7,000 cash and $400 of supplies into the business. As a result, cash increases by $7,000, supplies increase by $400, and owner's equity increases by $7,400. Miss Nadia received $4,200 for services rendered. Consequently, cash increases by $4,200 and owner's equity increases by $4,200. Miss Nadia purchased equipment on account of $3,700. This causes equipment and accounts payable to increase by $3,700. Miss Nadia paid $750 for supplies. This leads to a decrease in cash by $750 and an increase in supplies by $750. Miss Nadia paid salaries of $2,100. The effect is cash decreases by $2,100 and owner's equity decreases by same amount. Miss Nadia paid $3,500 for land. Consequently, cash decreases by $3,500 and land increases by $3,500. Miss Nadia paid $2,000 on account from transaction 3. This leads to a decrease in cash and accounts payable by $2,000. Miss Nadia paid utilities of $200. Thus, cash and capital decreases by $200. Transaction 9 paid $300 for supplies and $700 for equipment. Consequently, cash decreases by $1,000, supplies increase by $300, and equipment increases by $700. Miss Nadia received $4,700 for services rendered. This causes cash and capital to increase by $4,700. Miss Nadia withdrew $2,000 for personal use. Therefore, cash decreases by $2,000 and capital decreases by same amount. The inventory of supplies showed $600 of supplies on hand. This leads to a decrease in supplies and capital by $850. Now, after all transactions have been recorded, both sides of the equation are perfectly balanced, each totaling $12,850. This balance means that the total value of what the company owns assets is fully matched by the combined value of what it owes liabilities and the owner's stake equity. This is essential because every transaction must maintain the balance between assets on one side and liabilities plus equity on the other. The key takeaway is that the accounting equation must always remain balanced. It ensures that every asset is financed either through liabilities or the owner's equity. Maintaining the balance is crucial for keeping the company's financial position clear and stable. Compute the missing element, which is owner's equity, using the accounting equation. To find the owner's equity, rearrange the equation. Owner's equity equal assets minus liabilities. When we substitute the values into the equation, we find that the owner's equity equals $5,000. Question 5. Mr. Ahmed begins business investing $4,000 in cash equipment valued at $12,000 and $1,000 worth of supplies. What is the equity of the firm? Let's carefully analyze the situation. Mr. Ahmed's total investment is divided among three types of assets: cash, equipment, and supplies. By adding up the value of each investment, the total of $17,000 represents the firm's assets. Since there are no liabilities in this scenario, all of these assets are entirely financed by the owner's investment, meaning the assets equal the equity. Therefore, the equity of the firm is $17,000, as it directly corresponds to the total value of Mr. Ahmed's investment in the business. Question 6. If Mr. Ahmed had included a $6,000 note payable, what would then have been his owner's equity? In this scenario, we would subtract this liability from the total assets, resulting in $11,000 for the owner's equity. Question 7. Supplies had a balance of $3,000 at the beginning of the year, and the inventory showed $1,700 at the end of the period. How should this decrease be recorded? In this scenario, the difference between the beginning and ending balances represents the supplies expense or the supplies used during the period, lower both our assets and equity at the same time. The difference between supplies and supplies expense is that supplies are what we have on hand. We consider this an asset because it represents resources we own but haven't yet used. These are recorded as part of our assets on the balance sheet. On the other hand, supplies expense represents the supplies we've already used during the period. Once we use supplies, they no longer hold value for future use, so we record that as an expense, and this expense reduces our owner's equity. I hope you enjoyed the questions on the accounting equation. Thank you all for listening. Goodbye.